Welcome to the Lion's Share podcast, where we break down today's most impactful research and bring fresh insights from the academic frontier straight to you.
If you're preparing for a finance research residency, and we're talking about the kind that needs you to know not just the theorems, but why they matter and what they leave out, then this deep dive is absolutely for you.
That's right. We've taken that optional reading list across your 3 sessions, and we've tried to structure it. Think of it as an intellectual roadmap.
A roadmap that moves from the perfect theoretical benchmark to the much messier reality of agency costs, history, and even physical space.
Exactly. This isn't just a list of papers. It's the evolution of corporate finance thought. We'll start with the classical foundations, then introduce the core frictions, things like agency conflicts, before we pivot to the more modern empirical puzzles.
And our mission here is really to distill these dense sources into their core insights, making sure you walk away with the threads connecting them all. Okay, let's unpack this. And let's jump right into session 1, which really lays the foundations for everything.
We have to begin with what is, well, probably the most elegant piece of financial fiction ever written, Modigliani and Miller's 1958 paper. It gives us that perfect, frictionless market benchmark.
The famous relevance proposition. Most people remember the conclusion, but for a research audience, what's the core mechanism M&M used that, shocked everyone at the time?
The mechanism is arbitrage, specifically personal leverage that lets an investor undo whatever the corporation does.
Right.
So Proposition I states that the firm's total value, and this is the critical part, the average cost of capital, is completely independent of its financial structure.
So if you plot it, it's not that U-shaped curve everyone expected.
Not at all. M&M's model predicts a perfectly horizontal line. Let's call it mem prime, which was just completely counterintuitive.
So if a firm tried to, say, load up on cheap debt and claim a higher valuation because of it,
the market instantly corrects. An investor just doesn't need the firm to borrow for them. If the levered firm gets overpriced, an investor can just sell its stock, borrow on their own account, and then buy shares in an identical unlevered firm.
And they've created the same payoff.
Exactly, but at a lower cost. And that action, that arbitrage, forces the price of the levered firm right back down until the values are equal again.
What I love about that paper is that even in their own perfect world, they presented this paradox about investment that I think a lot of people just miss.
You're talking about the investment cutoff.
Yeah.
Right. The financing choice only doesn't matter if management makes good investment decisions. They showed that if a manager borrows to fund a project where the return is below the firm's overall capitalization rate, so ROSTAR is less than ROIC,
then the stock price actually goes down.
It has to. The shareholders get penalized because the market discounts the stock for that extra leverage, and it totally wipes out any benefit from the cheap debt. The takeaway is crystal clear. The cutoff for new investment is always the firm's capitalization rate. It doesn't matter if you use debt, equity, whatever.
That sets the benchmark perfectly. And now we move straight into reality with the first big friction, human behavior, which takes us to Jensen and Meckling.
Yes, their 1976 paper that defined the firm as a nexus for a set of contracting relationships. J&M really introduced the idea that a firm's value is actively reduced by costs that come from different people wanting different things.
And they split that into 2 main agency conflicts. Let's start with the internal one, the agency costs of equity.
This is the manager-owner conflict. So when a manager's ownership stake is less than 100%, they have an incentive to, consume non-pecuniary benefits.
Things like luxurious offices, corporate jets.
Exactly. All at the expense of the outside shareholders. So the firm's value gets dinged by the costs of trying to control this, monitoring costs, bonding costs, and then whatever slips through the cracks, the residual loss.
Okay, and then there's the second, and I think often more dangerous conflict, the agency costs of debt.
Right, the external conflict. This is all about asset substitution or risk shifting. Think about it. Equity holders basically own a call option on the firm's assets.
They get all the upside, and the bondholders get stuck with the downside if things go bad.
Precisely. So that incentivizes them to take on really high variance projects. A riskier project increases the value of that call option, and that value is transferred directly from the bondholders to the equity holders. It's why bondholders write all those covenants into the contracts.
And the final, almost poetic conclusion of Jensen and Meckling is who actually pays for all of this bad behavior in the end.
It's the original owner-manager. The person who creates the problem in the first place bears the full capitalized value of all of it. The market is rational,
So it sees it coming.
It sees it coming. When that owner first issues debt or sells equity, Investors discount the price they're willing to pay right up front because they anticipate the future agency costs. So the owner effectively pays for their own future misbehavior. What's fascinating here is we're moving from a world where contracts can mitigate behavior, like in J&M, to the deeper problem that Hart explores in 2017. What happens when contracts just can't be completed?
Right, Hart's work. The idea that you can never write a contract that specifies every possible future decision. So ownership or control becomes the right to decide in all those situations the contract didn't cover.
And that incompleteness just fundamentally undermines efficient bargaining. This is where the Aghion-Bolton model he discusses is so important if the manager who needs the funds is wealth constrained.
Meaning they just don't have the cash on hand.
Right. They can't make side payments to the investor to convince them to give up control rights, even if the manager would actually be better at making the decisions.
So because of that wealth constraint, the Coase theorem breaks down. They can't just bargain their way to the best outcome.
Exactly. Who gets control isn't determined by who's the best manager, but by who has the initial wealth. Hart uses that great public versus private prison analogy to bring it to life.
Yeah, tell us about that.
Well, if you privatize a prison, the private owner has control. And they had this massive incentive to find cost-saving ideas, right? But since the contract can't perfectly define quality, those ideas might be things like skimping on guard training.
Things that hurt quality but boost profit.
And that's the trade-off. Private ownership can spur innovation, but risks quality. Public ownership protects quality, but it might stifle those good cost-saving ideas. It's all about who holds those residual control rights.
Okay, so to wrap up session 1, we ground these theories in some modern data with Whited and Zhao from 2021. They actually try to measure this misallocation.
And they do it with a really clever financial production function model, treating debt and equity like any other input, like labor or capital.
The results are pretty staggering, right?
They're huge. In China, for example, they estimate that value added could go up by over 70% if debt and equity were allocated efficiently. That puts financial misallocation right up there with misallocation of capital and labor. It's a massive source of inefficiency.
But the key distinction they make is where that inefficiency comes from. Is it the structure of finance or is it the scale?
And this is so crucial for you as researchers. While the type of finance, the debt-equity mix, it matters. It contributes maybe 10 to 15% of the potential gains.
So it's not the main story.
Not at all. The vast majority of the misallocation comes from the scale of finance. The biggest problem isn't that firms use too much debt. It's that the most productive firms just aren't getting enough total funding compared to less productive ones. The real failure is getting the right amount of money to the right firm, period.
That's a perfect transition. So now we move into session 2, looking at the real-world stickiness and history of these capital structure decisions.
We can start with Lemon, Roberts, and Zender from 2008. They begin with this really stubborn empirical puzzle. Why do all the traditional things we think should determine leverage profitability, market-to-book, tangibility, why do they explain such a tiny fraction of why some firms have high leverage and others have low leverage?
And it's not just about copying your peers either, right? I remember they showed that industry effects are pretty small.
Very small. A one standard deviation change in the industry median leverage only translates to about a 6% change for any given firm. What they found, and this is the paper's big contribution, is this incredible degree of persistence.
So a firm's history matters. A lot.
It's the most important factor. The level of leverage a firm starts with is the single best predictor of its leverage ratio, years, even decades later. Highly leveraged firms just stay highly leveraged.
Which suggests either that firms adjust back to their target really, really slowly, or there's some huge sticky factor that our models are completely missing.
Exactly. It's path dependence in a way that our theories have really struggled to capture.
That idea of history sets the stage perfectly for this massive historical shift, which brings us to Benmalek, Kumar, and Rajan on the decline of secured debt.
The numbers here are just stunning. I mean, at the start of the 20th century, nearly everything was secured debt. We're talking 98.5% of all bond issuance.
And today?
For investment-grade firms, by the early 2000s, it had plummeted to below 5%. It's a fundamental century-long transformation in how corporations finance themselves.
So back in the 1900s, what made collateral so appealing? Why was it the default choice?
It really boils down to monitoring costs, which brings us back to J&M. Collateralizable assets, like railroad tracks, factories, they're distinct, they're easy to value, and they're hard to hide.
So they require less active monitoring from the lender.
Way less. especially compared to uncertain cash flows that a manager could easily divert. Secured debt was just the cheapest solution to that information problem.
Okay, so if the benefits were so clear, what costs eventually drove its decline? It has to be about flexibility, right?
It's all about flexibility, both financial and operational. The first cost is losing financial flexibility. When you pledge your best assets as collateral, you're using up your cheapest source of financing first. That leaves you with fewer options if a shock hits later on.
But the operational cost seems like the real killer, especially when a firm is in trouble.
It is. Giving collateral hugely strengthens the creditor's bargaining power in distress. This can lead to them pushing for liquidation or holding the firm up, forcing the sale of key assets to get their money back.
Like core patents or technology.
Exactly. And that loss of operational control is just too big a risk for a modern company whose value is tied up in unique, intangible assets.
The Ford example from 2006 really illustrates this, doesn't it?
It's a perfect example. When Ford mortgaged basically everything it owned, only about 22% of that was traditional things like plants and equipment. The vast majority of the collateral was intellectual property, trademarks, inventory.
They had to pledge their brand, their identity.
Essentially, yes.
It shows how the nature of collateral has changed, but that fundamental trade-off monitoring benefit versus the cost of losing operational flexibility is still right at the heart of the decision.
Here's where it gets really interesting. We're moving into session 3, and we're diving into investment dynamics and the nuances of debt maturity, revisiting that classic debt overhang problem with Diamond and He.
Right. They really add a lot of nuance to the original Myers argument from 77. Myers basically said long-term debt creates more overhang than short-term debt because it captures more of the value from future projects. Diamond and He show it's more complicated than that.
So let's start with our first result, which kind of confirms the old intuition, at least in a static world.
Right. In a simple static Black-Scholes-Merton world, if you hold the initial market value of debt constant, they confirm that long-term debt does impose stronger immediate overhang. Short-term debt is just less sensitive to the value created by a new project.
But the whole story flips when you bring in dynamic investment opportunities.
This is the core insight. Shorter-term debt shares less risk. That's a good thing, but it also means that the future value of equity, and therefore the future debt overhang problem, becomes much more volatile.
And that volatility has a dangerous side effect.
A very dangerous one. It can actually push equity holders to default inefficiently early in the future.
And an early default kills off all the future investment opportunities that might have existed.
Precisely. So short-term debt might solve today's overhang problem, but it creates this fragility risk down the road that could destroy even more value by wiping out future growth.
So there's a real trade-off.
A huge one. And they argue this applies especially well to financial institutions, such as banks, which rely on short-term funding. It suggests the overhang problem for them in bad times could be absolutely massive.
For our final paper, we shift gears completely. We're looking at how something as simple as physical proximity impacts real investment with Giroud's 2013 study.
This is a fantastic link back to agency costs, but at a really granular level. Giroud uses this great quasi-experiment. What happens when a new airline route opens up? Reducing the travel time between a company's HQ and one of its plants.
The idea being that it's just easier for senior executives to go visit and monitor what's going on.
Exactly. It reduces the friction of travel, giving them better access to local information.
And what's the result of just making it easier for the CEO to get on a plane?
A significant increase in that plant's investment and a measurable increase in its total factor productivity, its TFP. It's clear evidence that a lack of proximity was a real binding constraint.
But that raises a behavioral question for me. If the productivity gains were so large, we're talking hundreds of thousands of dollars in profit, why weren't CEOs already making those inconvenient trips more often?
And that takes us right back to Jensen and Meckling. CEOs are time constrained, and they only have a tiny ownership stake, right? Maybe 1 or 2%.
So even though the firm was gaining, say, $300,000,
the marginal personal profit gain for the CEO might only have been $4,000. And that small personal gain probably wasn't enough to justify the huge personal time cost of a complicated travel day for a wealthy executive. The new airline route just lowered that personal cost barrier.
it made the trip worth their while.
It made it worth their while. If we connect this to the bigger picture, you can really see the field's progress here. We went from M&M's perfect, frictionless world through J&M and Hart's world of human friction and messy contracts.
And then into the granular reality.
Exactly, where things like institutional persistence, the history of collateral dynamic contracts, and even, the physical distance between a manager and a plant can dramatically shape real outcomes.
So what does this all mean?
It means that while the core theories give us the language, the most interesting research today is found in the frictions and the constraints. It's in realizing that the scale of financial misallocation is more important than the type, or that short-term debt isn't some magic bullet for investment overhang. The real world is just messy and sticky.
So, given the strong empirically documented persistence in firm leverage and the critical role of asset ownership in these incomplete contracting models, you should consider this provocative thought as you prepare for your residency. If today's leverage ratio is so persistent, and if ownership dictates control when contracts fail, what long-term, non-contractable corporate policies or even organization designs could a firm implement today to try and lock in an optimal leverage structure for the future, even if that choice seems suboptimal in the short run? Good luck with your research.
Thanks for tuning into the Lion's Share podcast. If you enjoyed today's discussion, share it with a friend and join us next time for more ideas worth talking about. We'll see you next time.